All right, good evening, everybody. Welcome to our Investors Copy Time on Tuesday evening. Today, we are really glad to have a very special guest. He needs no introduction in the real estate and really real estate investment trust industry. One of the pioneers in real estate investment trust or REITs. We have Dr. Stephen LeBroy with us. Later, Alvin will do more introduction for him. But before we start, this house rules. Please take note that the content of today's discussion does not constitute any investment advice. It is for educational purposes and informational purposes only. All right. So if you want to seek advice for investment, you have to seek a qualified investment professional. If you wish to purchase any shares, investment products, or services. All right. So now we have this cleared. Like I said, today we have Dr. Stuart LeBroy, who has actually been with us in our club meetings, all right, exclusively for our members. He has been with us, I think, how many times, Alvin? Few times, right?
Once, one time. And this was back in 2018, October. So this is almost 18 months. So what you're seeing is actually our old office, right? Well, we have moved, but yeah. So that was when we last met, our members last met Dr. Stuart LeBroy. Yeah.
Yeah. Hopefully we can bring Dr. Stuart to our new office.
Yeah, that's very nice.
Yeah. This is the old one. All right. So yeah, so later you're gonna hear from Dr. Steve. He have actually prepared quite a lot of things for us, insights about the real estate industry itself, and also the REITs, right, or real estate investment trusts. Okay, so before we start, I think we're still waiting for the others to come in. For those who are still new with us or those who have already with us for some time, if you wish to access our equities tracker platform, you can still do so. All right. Just WhatsApp us at 603-8408-2070. Now, I know you've been asking whether we'll be extending our free platform, because we only provide this until the 30th of April. But for those who subscribe after 16th of April, all right, you are getting an extension of 2 more weeks. Okay. Only for those who have subscribed 16th of April onwards. That means if you subscribe today, you still get an extension of another 2 more weeks. Okay. For those who subscribe before 16, please bear with us. In the next 1 or 2 days, we're going to make an announcement where you are able to continue the subscription. We have actually a very special package for you guys. All right. Because you've been with us for some time. You have been us since the MCO, and this is like our 39th. I've already counted our 39th Investors Coffee Time. All right. So to appreciate you guys, we're going to come up with a very special package because our team are actually working out with the package, and that's the reason why it takes some time for us to come something special for you guys. Okay, so
first time we're gonna do this, right?
Yeah, so we'll announce this in the next 1 or 2 days, so you are able to continue to access this, and most importantly, use this platform to also go to our ET online campus where you are able to continue your learning there. All right. So WhatsApp us at 603-8408-2070. And later, with Dr. Stephen LeBroy's permission, we are also going to include his presentation slides in. So you want to get the presentation slides, you still have to WhatsApp us at 603-8408-2070. Okay. And for those who want to join us in our ET online charity campaign or our online campus, where we have our tutorials in there with regards to investing. So we have actually value investing principles, which is being shared by Alvin. And for those who want to look at price chart analysis, then my contents will be there. Okay, so there are like I think about 30 over videos, nearly 40 videos in there for you to actually learn, investing. Okay, whether it's fundamental analysis or technical analysis, right? And then every week, Alvin and I will also be in the campus once in a while to meet you guys online, right? Today, Alvin was there at 3 p.m. right, for 1 hour. Yeah. And then tomorrow I'll be in the campus for 1 hour. So we have actually this mentorship, which is going to go on, right? It's not going to stop until the COVID. This is going to go on as long as Alvin and I are here, right? So this is a charity campaign. All you need to do to join our ET online campus is, you just have to donate 100 ringgit to any charity, right? Any charity that you want. If you do not know which charity to donate to, just go to charity.equitiestriker.com. That's where we'll give you actually a few suggestions. All right. So to participate, all you need to do is to donate 100 ringgit, and you are able to bring also 3 friends to join our ET online campus. Okay. After you make the 100 ringgit donation. So just go to charity.equitystriker.com and register from there. All right. So we already have collected, I think, about 120 plus. I didn't get the right. This was yesterday's figure. 124,000 was yesterday. So it's really about half of what we are trying to achieve, which is 250,000. And for those who have just joined us, if we reach 200,000 ringgit, I have to bring this up, like Alvin. Alvin is going to go bald. He's going to shave his hair bald. Right. So Dato, if you have any friends who want to do a donation, ask them to join the charity. Right. If you want to see Alvin go bald,
take it to Alvin.
All right. So yeah. So join us at charity.equitystriker.com. All right. So that's for now. I think I'm going to pass this to Alvin to kickstart this session because you don't want to delay any more time. All right, Alvin.
Thank you. Thanks, Benny. Okay, welcome everybody. I see a lot of you guys are slowly streaming in right now. Now, this was due to popular request. We got a lot of questions regarding REITs. How do you analyze them? And a lot of them are looking really attractive based on their previous yields, right? So the question is, are these value traps at the moment because you get 10%, 12% yields because the prices have dropped so much? Obviously, we are still currently on MCO, and I believe the government has just announced that those that were allowed to operate on phase 1, phase 2, phase 3 of the MCO are now allowed to operate fully. So it seems that things are improving, and I think today is only 19 cases that were recorded. So we decided to bring the pioneer of the industry, Dato' Stuart Roboy. He's actually a baby boomer, but he thinks like a millennial, right? And he's agreed to come on the show to share with you guys all his knowledge about REITs. Yeah, so we are very glad to have him. We actually last had him at our subscribers only meeting, which is in October 2018. Exactly, it was 25th of October 2018. And he shared with us regarding REITs, but I think the interest now has probably come up even more immensely. So his presentation is going to focus about what's going to happen post-COVID-19. If you're not sure what a REIT is, you can go and Google it. It's effectively a trust that holds property. So it's a way where you can buy shares on the stock market like you buy your normal shares, but you actually get rental or distribution income, right, at the end, at every quarter or however often they distribute, okay? Dato' Stuart Roboy is also a pioneer in this industry. Why do I say that? He has since retired, but he was the ex-CEO of Axis REIT, Berhad. I believe it was the first REIT listed in Malaysia. Before any REIT was listed, that was the first REIT that was listed. So he's got a lot of experience, and we had a good chat about what do I think, or ask him what he thought was going to happen to REITs post COVID-19 once the MCO was lifted. So I'm going to pass the ball to him. Thank you very much, Dato', for being here. Very highly appreciated your time. Now, we have also extended today's session to 90 minutes. So we're going to end at 9:30. So the Mandarin session will only start at 9:30 because we wanted to give more time for Dato' to go through some of the slides. Over to you, Dato'.
Let me see.
Yep.
Thank you. Thank you very much, everybody. Thank you for inviting me. I can't see anybody here. I assume there are people out there in the virtual world. Thank you, Alvin, and thank you, Benny, for extending me an invitation today. I know that we're here today to talk about the impact of COVID on real estate, and particularly real estate trusts. I think that everyone's very worried because they've seen the stock market take quite a tumble since the lockdown started, and everyone's asking, so what do you invest in at this time? Are we at the bottom yet, or are we not at the bottom yet? This is a big question everyone asks. And I think you must be able to understand your markets better to make judgmental calls. Every company has very strong fundamentals, the good ones. And they tend to weather all kinds of ups and downs and always come out stronger. What is very interesting to see happening today is that, before COVID, everyone used to sort of say, oh, we're Industry 4.0, we're doing the digital revolution, and did nothing about it. Now, there's a huge shift, a physical shift to go digital. And I've seen it happening all over. The mere fact that people are now using Zoom and Microsoft Teams to have meetings and finding them very, very productive. Really, we go through our meetings a lot quicker and they're far more productive. They're quite exhausting though. But the fact is that your productivity is up like about 25 to 30% over what we used to do before. it also brings into question, how is that going to impact real estate? Human behavior eventually sort of dictates how real estate is going to be moving forward. So I'm going to start off with a few slides. If I can find the clicker. Yep, here we go. This is my little disclaimer. Okay, I'm going to talk about the impact on REITs. I think I'm trying to dive straight into the subject because I think this is what's on everyone's minds, okay? So let's see. First slide. What do we expect? I think the first thing is that don't expect quarter one results from REITs, because the nature of the beast is that all REITs collect their rent in the first of the month. So the March closing for that quarter, they would have got all their money in already. The chances of having any losses are probably minimal. They might have saved a lot of money on electricity, like the shopping malls, because they weren't running the air conditioning. So they might have lower overall costs of running, but their rents for that month were intact. Okay. Now, once the lockdown has started, quarter two rent collections could be impaired. Be prepared for that. Most REITs, you must understand, have long rental agreements with their clients. And most REITs actually have very good tenants occupying their buildings, who actually have very deep pockets and can actually weather the storm. But some REITs will probably have shorter leases, most particularly in the malls, where they tend to run 2-year rotational, tenancy agreements. And the trouble is that maybe some of their tenants may go bust and walk away. So there will be a problem. I think there will be probably an income gap in the second quarter that may sort of drift into the third quarter as people slowly get back into the habit of going to malls. But I've always said that Malaysians have a very bad habit. I call them mall rats, because they can't stay away. You go every time, the malls are full, people like visiting malls. It's a outlet for taking the family, having meals. It's not just a place to go and buy things. It's a place where people go and have leisure. So, it's still a very popular piece of real estate. And I think they'll get their act back together before the fourth quarter. I think fourth quarter is going to be, hopefully, where we're going to land up in getting back to what I call normal. Okay. Office REITs also have long-term contracts in place, and most of their tenants have deep pockets. Take KLCC. Their main tenants are Petronas. I don't see them going bust. So their rents are very, very locked in, and their leases increase in value every 3 years when the rental is reviewed. So they're on a constant sort of increase in revenue. So they're fairly safe bet at this time. However, some of the office REITs may have shorter term tenancies or tenancies coming to an end. So that may be a problem. So when you look at which office REIT you want to invest in, and believe me, their yields are very attractive. But what you must understand, I'll talk about it later, is that they're all running very big, steep discounts to their valuations. Some as high as 60%. So if a building is valued at 100 million, you can technically buy your units at 40 million. So you're getting it very, very cheap. If you look at the valuations against the NAV, it's called the discount to NAV. It's a very important ratio or metric that anyone investing in REIT should look at. It doesn't mean that it's going to bounce back. It may be terrible assets. So you don't know if, because it's being traded so low, it's a great asset at a bad rent, but it could be the fact that it's not a very good asset to begin with. I think the least affected in this whole market will be the industrial logistics REITs and the healthcare REITs, because their share prices, if you look at it, and I'll share with you later, have held up very, very well. Okay. The REITs, the Malaysian REITs, have been very proactive and have appealed to the government for concessions to tide them over the period. Whether they get them or not, I don't know. Some REITs may decide to issue units in lieu of cash dividends. Now, Access REIT used to do this. It's called the Dividend Reinvestment Scheme, or the 𝐈𝐧𝐯𝐻, where unit holders can choose to take units instead of dividends. So many REITs are looking at changing their style of distribution into issuing units instead of cash, to conserve cash. And I think unit holders should take the opportunity to accumulate accumulate units at this point in time, because they also will be quite low in price. So they're getting more units for their money than they bargained for. And just accumulate at this point in time. Some REITs who are really at the edge may resort to rights issues, which I personally dislike, because I think they're terrible destroyers of valuation. Normally, when they have a rights issue, the share price drops and very rarely recovers. Managers may also take units in lieu of cash to boost distributions. Because now they take cash in terms of their management fee. They may convert that into units instead, putting the cash back into the system for giving out distributions. You have to study which REITs actually are looking at that. and decide which way you want to invest. Okay, but don't forget, the nature of the beast, REITs, will always pay you a dividend. Corporates will not. Many corporates and us put up their hands and say, I'm not paying dividends this year, openly. But REITs have to pay because that's the mandate, and that's why they're listed. So you'll always get a dividend by investing in a REIT, okay? So I think looking forward, this is a table of the KLCI and the REITs and the REITs index. Okay, you can see that, there have been some big drops. MRCB Quill down 50%, These are real interesting and you look at the asset quality, it's pretty good. A lot of stuff's in KL Central. They got a lot of stuff in Cyberjaya, good clients, good tenants, but they're still being quite badly hampered by a huge discount on their price. So how will the market view REITs? They're like property stocks where there can be a value trap due to deep discount to net asset value. All REITs business model is dependent on lock-in rentals. So they have very, very high certainty of cash flow. Okay, and the recent sell-off has made dividends far more attractive. Now, sometimes you think that buying very high dividend yields, yielding REITs is a good idea, but always look at the graphs. If you're looking at that, just study the REIT and see if their income has been increasing or decreasing over the years. Because if it's decreasing, you'll be able to get a 12% discount, 12% dividend, but the share price may discount by 20%. So you're minus 8% for the year. Always look at total return when you do an investment, not just the dividends. You got to look at the cash value or the value of your units in the market. Because if the REIT's not doing well, the share price will drift down and you net off that big dividend you're getting with a drop in your share price. So total return may not look as great as it is. All right, here's some charts, okay? These are up to date, right up to April the 23rd, okay? So MREITs have significantly outperformed the KLCI. That's the yellow line. The REITs, the REIT index is on the blue line, and the property index is on the green line. You see, they've been very badly impacted by they're almost down like 25 to 45%. So there is a very interesting correlation between the REIT market and the property market. But the MREIT index has fallen off a cliff, 960 to 770, okay? It looks very dramatic on this curve, but if you put it back to a zero base, it probably isn't that dramatic. But it's quite a drop, okay, since mid-March, okay? So that's been a big drop. If you're playing the indices, you might have lost money. And its historical price to book year performance over the past years shows that it's down, okay? It's really at the very low end of the scale, which is not very encouraging. Now, this is a very interesting graph. Market cap has actually dropped by $3.5 billion to date, okay? You can see that market cap in December 2019 was higher, and now it's dropped for all the various REITs, which means a reflection of the share price coming down. The market cap's a reflection of their share prices. So you can see all of them have literally fallen down. There's not many who have got a narrow gap. The ones you can see, pick out here, but the narrow gap is like, there's Axis there, quite not a bad drop in market cap. Atrium, also industrial, not bad. Amphos actually showed an increase, strangely enough, and MRI as well. Sorry, all have shown drops, sorry. All the blue lines are down. Axis has actually gone up. Sorry, I'm looking at the wrong line. Axis is one of the few that actually have shown that their market capitalization has risen in this downturn, as well as Al-Aka, which is also the healthcare REIT, which I mentioned earlier, the two darlings of the investment community. The rest are all below, okay? KLCC, not much, very small margin, but they're also a little bit down for the year. Now, this is an interesting chart. Premium discounts to net asset value. All the green bars are the ones who are doing well. All the red bars are the ones who are not doing well. They're all trading at fairly steep discounts to their net asset values. And don't forget, these assets are valued every year. So the value is there, but they're selling at, like Amphos is selling at nearly 63% discount to their valuation, okay? It's huge. Amana Raya is trading at nearly 55%. You have Amana Hartana at 40%. You've got Hector REIT down to nearly 50%. CMMT is down by about 35%. Tower REIT's down about 60%. So YTL also for hospitality REIT has come down quite sharply, nearly 40%. So these are telling times when the prices are reflected to how the market perceives them. You see all the green ones, Al-Akas Healthcare, Axis Industrial. IGB is a very strange REIT. It's always done extremely well. And although they're actually trading at a premium to their NAV, their dividends are actually holding up very well. So I would say if you want to see how asset is performing, reset their yield, the discount to zero, and then look at the yield. I think IGB is giving a 4.5% to 5% now, if I'm not mistaken. If you brought their premium, their net asset value to zero, their property yields are running close to 10 to 12%, which means that the assets are performing very, very well. That's why they traded up in price to bring the dividend, the yields down. Okay. I'm sure.
Can you explain a little bit, maybe to our viewers, what you mean by bringing the value down, as into zero?
Okay, when you say net asset value, see when you're trading at a premium, okay, like say the share price maybe today I think IGB is trading about 170, okay, but technically speaking, if you see their net asset value, it's like maybe 120. So 160 or 170, they're giving you 5%. If you said it was 120, what would that yield be?
Right, okay.
Right? So you take it when you bring it down. Same thing there. If one of the red bars go up to zero, the yields drop to about 2-3%. That tells you the property performance. It's a very good bellwether to check whether the properties are performing at their valuation or not. Okay, I think that's a very important metric that you should look at. So these are all trading at premiums. They tend to be the ones with the strongest share price and the ones that sort of lost least value in this market.
Would you be able to comment on why do you think, I think for like hospitality, I think that's you know, quite explainable. Why do you think some of these guys are trading at such huge discounts, like AmFirst or Amanah Raya, or even Hector, for example? You know, why do you think they're trading at such huge discounts?
Well, you see, the thing is, when you look at a REIT, if you take it over its historical timeline, if it doesn't grow, okay, it runs into what we call a lack of interest by the investment community. They always say, when is a good time to buy a REIT? I say anytime, so long as the manager is good and they're increasing the turnover and they're adding more assets to the portfolio and they're increasing their DPU. Because when the DPU goes up, their share price goes up. So they're actually betting on these kind of companies with the premiums that they can maintain their performance and increase it over the years. So if you're going in at maybe a 40% premium, 3 years down the road, it may be 60% premium. So you get what's called a total return in terms of your share price plus your dividend.
Yep.
So if you look at the numbers that were actually analyzed, if you look at Axis on the first 10 years of its performance, its average return to investors was 25% a year in terms of share price appreciation plus dividends. So if you take that into account, that's your total return story. That's why it commands a premium in the market, because it outperforms the market. So when performance comes into play, you'll see the winners actually emerging. IGB does a very good job in terms of their return on their valuation. They're getting much better returns on their valuation in terms of yield. Okay. Unfortunately, YTL was doing very well at one time, and I think the reversal has been very sudden and very sharp over the COVID. You know, hotels have suddenly gone from being very popular to a very, very difficult one to make an investment case for.
Yeah.
So these are your distribution yields. Okay. You'll notice that the highest distribution yields are related to the ones with the worst premium discounts to valuation. Okay.
Yeah. So
unfortunately, I think I missed out the names of these various REITs. But just to let you know that the average yield in the market today is 7.5%. What's equally interesting is if you put it against the 10-year government bond, which has fallen dramatically to 2.9%, you have nearly a 450 basis point gap, delta between the two. And that's massive for the historical Malaysian REITs. They used to be 200-300, that's not as low as 90 basis points, you know, when the MGS was around 4.5 to 4.5%. Now they're gaining a huge premium in terms of the returns.
So how do you see a lower interest rate environment, vis-a-vis pricing of the REITs currently? If interest rates, because CMB I think recently came out and said that they're expecting Bank Negara to drop an OPR by 75 basis points. Do you think it will affect the REITs in a sense that are they geared, or are a lot of them geared?
A lot of them, actually, the average gearing for Malaysian REITs is around 35%. There's some 35. Lower than that. 35 to 40% is the normal gearing limit. You'll see most REITs that hover around that area. It gives them enough of a midpoint to actually not sort of get into danger zones. So what you see happening is that some REITs are actually on the limit, okay? And they're really running into a problem in case their valuations fall, then their gearing levels may rise above 50%, and they're in breach of the SC rules. So they may have to do forced selling of their assets to cover their positions. Right. But I think the REIT Association has asked the SC here to let them temporarily lift the limit of the gearing. Singapore has done the same thing, by the way, because they worry also the fact that there may be REITs running into trouble by having the debt higher than their allowable amounts, by basically the fact that the valuations of the assets have been dropping so hard. This is basically a board of the companies, okay, in the REITs, which are actually trading at the premiums, okay? Shows their performance. As you can see, their share prices have done extremely well over the time. You don't see very much movement. Pavilion's come down a bit. KLCC has held up very, very well. IGB has held up well. They've come down from their top numbers, but they're still very, very healthy. Axis again at 191 is nearly historical high. Okay, so they're really playing the maintenance of their performance very, very well.
Right.
Now people say,
the profile of them as well. Right?
Axis REIT, the yields are so low, right? I think the yields are about 5%. But don't forget, you get a share that's rising in value and getting 5% a year. So I said the total return, okay, if your share price goes up by 10% a year and you get a 5% dividend, you're 15% up. Beats everybody. And you really have a much better sort of return on that basis. So let's talk a little bit about more REITs, okay? Now there are these main ones here: Hector, Sunway, CMT, Pavilion, IGB. Not pure malls. They have some hotels here. Sunway, of course, is slightly diversified, but anchored by malls. There are 3 very large malls. CMT is a pure mall play. Pavilion REIT, same thing, pure mall play as IGP. They're all pure mall, pure mall plays, okay? So these are the charts, okay? As you can see, the chart doesn't look very happy.
Well, I think for value investors, they are quite happy.
Of course, yes. You get a chance now to pick up. Look out the Sunway was actually running up to 190 price, and now they're down to 150. Bloody hell, that's a good time to pick up. It's a very solid stock. Hector, same thing. But Hector has traditionally been very flat, at around 95 to $1, and they've fallen down quite dramatically. Okay.
Yeah.
KopiTime REIT is an interesting stock because they have a different kind of business model, and the thing about KopiTime REIT is that they're almost owner-run because they actually are very hands-on as a unit holder as well as a manager. They're very, very into their business. They're very
Which are IGB? Is that
KopiTime REIT? They're small. Yeah, they're giving decent, about 7% dividends right now. They're about 8%. They're trading well below the IPO price. Yeah. And I think because they're more like the open market kind of concept, they will do well in the long run. They remained open right throughout the COVID shutdown. The MCO, they were actually open all the time because they were food suppliers, and they actually leveraged on that. See, they were very much like a marketplace. IGB, of course, has also fallen down from their highs, and really they were floating up nearly $2 a share, and now they've come down quite dramatically. So there's a chance to bottom fish. It's a quality asset. The only question we have to ask ourselves is, how do you view real estate of malls moving forward? Are the crowds coming back? Are the tourists coming back? Certain of these malls depend very heavily on tourist traffic. Many of them depend on local traffic. So you have to see what impacts they're likely to have. If they're highly premium malls depending on tourist traffic, you might find tourism being very depressed this year as people sort of shy away from traveling. So I think that's going to be a very, very slow pickup in terms of tenants coming in. But bear in mind that Pavilion has long leases in place, and they renewed a whole bunch of them early this year. So I think they're probably okay from their revenue point of view. Okay.
What do you think will happen if say the tenant goes bust anyway, and they move out? Is there any form of compensation? Do you think they will be able to replace those tenants, or so how does the contract kind of work with these malls?
Well, I'm not sure how the contracts are written, but they tend to be fairly short tenure, except for the anchor tenants, which tend to take long positions. They'll take 10-year leases. If it's a Parkson or another one like that, they're going to take long positions. But I think malls are also changing in character, becoming more entertainment rather than retail. Retail is most migrating to online now, or going omni-channel. So that's going to be the big change in the markets. So you'll see that Pavilion is down, but it's not out. It's a quality asset, very quality, very high, very priced assets. These are irreplaceable assets, and if you get a chance to pick them up they're not trading at a very high premium yet. So the moment they hit no premium, jump in, because you're going to get some upside there, I think, in the long term. They're very well managed malls. They're very well managed REITs, I'll tell you. I know the managers personally because I served with them on the REIT association, and they're very dedicated to sweating their assets and making sure they get the best returns for their shareholders. But don't forget, they will always pay you a dividend. Okay.
Dato, just to get an idea, I think for those who are maybe out of town, for viewers who are not maybe from KL that's watching this, would you able to sort of, I guess IGB would be Mid Valley, right? Am I right to say that?
It's only Mid Valley. There are only two assets.
Yep.
Yeah.
Which is just Mid Valley?
Mid Valley and the Gardens.
Mid Valley and the Gardens. How about Sunway? Sunway, is that just Pyramid?
Oh, no. Sunway's Pyramid. They have the one opposite they have the new Velocity. I think they got the one.
What used to be called the mall, right?
And they've also got some giant properties up north.
Okay.
They own what's the other mall? The one opposite the Putra World Trade Center.
Yeah.
The Legend Hotel before.
It used to be called a mall, I think, right?
Putra Mall, sorry. The Putra Mall, sorry.
Yeah,
Putra Mall as well, which they refurbished when they bought it. So they have quite a mixed bag. They're basically in office, they're in hotels, they're in malls, they're in education, and they also have a small industrial investment as well. So they're pretty spread out. So it's hard to say whether that's going to give them the kind of diversification to ride the storm out or not. Sometimes having all the same asset, you can be impacted quite badly. If you're diversified, you may be able to cushion. But I think the important thing is that for people who are investing, they got to pick their winners now. They got to look at the future and say, okay, this is the assets that are going to perform moving forward. Better put your money in there, get a decent dividend, and probably the share price will not sort of deteriorate, might increase in value over time. The thing
what about KIP and CMMT? Sorry, what about KIP and CMMT? What sort of or Hector, right? What I know Hector is Subang Parade, right? That's one.
There's Subang Parade. There's Malacca Parade. They have a mall in Muar. They've got a couple of malls up north. They're still very much a mall operator. I think one in KL as well. I'm not sure, but they have quite a diversified geographical spread of their malls. So in fact, what you find that the regional malls do very well. If you look at the CMMT's performance, the East Coast Mall, which they acquired recently, has done well. The Penang Gurney Drive one has also performed very well. But the ones in KL have been struggling with Tropicana, the Tropicana Mall they bought, now called 3 Damansara, and they've also had the acquisition of the one in Mines and of course your very famous Sumaiwang. There were three that they've actually been. That's been a bit of a struggle for them, but they're really active asset managers. Give credit to the management; they're doing a very good job. They never give up. They're always finding new ways of attracting tenants in, and they have quite a good following with tenants. So I think having tenants leave them is probably not really on the cards. They've inherited malls where they try to reshape the tenant mix and try and get the kind of tenants they think would work, and they will succeed eventually. They're very well. And don't forget, they're also Singaporean run who understand malls very well, and they really have a very strong management team to manage the malls as well. Very hands-on. So they had a bit of a bad run of luck, but I think they'll come out of it. They're trading very much at a discount now to their share price, so they will do well. But I think they're having the trouble is when prices drop and yields go up, very hard for them to acquire, because they have to find accretive assets, and they can't find, if they're giving 8% yield in the market, they can't find equivalent assets with that kind of yield at the moment. So they're really stymied in terms of trying to grow. So they're hit by a brick wall, so they have to wait for the markets to correct and their share price to start rising again. So the ones that work hard at this will get back on the market. If the Chinese tourists return to Malaysia, Pavilion will do very well. They'll bounce back to the very high prices they had before. So all these things are things you have to look at the markets and decide when you want to jump in. I'm not giving investment advice, but always study the various REITs and their customer base and their tenant structures. Very, very important. And their basically exposure to debt. Because some of these trusts have got very, very low gearing. And they therefore have a lot of headroom to actually buy on leverage. And leverage now is cheap. The bank loans have come down in value. And it really makes it an attractive proposition to go a little higher on debt and try and get better yields from that. So I'll take questions on this later. So let me move on. Okay.
Yeah.
So back to the industrial REITs. Okay. Quick sort of snapshot. We talk about oversupply. It's a highly tight sector, very underinvested, underdeveloped as well. And I've been in the industry for nearly 15 years now, and I've been railing at everybody, even the government, saying you have to start building more industrial estates, because you're being overtaken by Vietnam and Bangkok and Thailand, who actually have a very good system of actually bringing foreign investors in. If foreign investors want to come and set up a factory in the Klang Valley, they have nowhere to go, literally. So it's now, because of the change in the market sentiment and the fact that building houses have become a real problem, together with also other commercial properties, a lot of developers are turning to the industrial sector to try and generate some profits now. So you're finding more industrial estates opening up. So there's a very interesting trend that's happening now. So, but rents actually, we talk about industrial, there are two classes of industrial. One is what I call the investment grade industrial. Those are the very large warehouses you see that you go to Shalam, 1 million square feet, 2 million square feet. You'll see them popping up now. The ones that are being built by the developers are the small semi-detached factory lots, 5,000 to 10,000 square feet. So those are not REITable. The ones that are REITable are the big sheds that are being built for specific clients and specific industries that take long-term leases with it. And that's where the money is, and that's where the investment should be going. Okay, let's see now, very exciting new mega distribution centers being built, all which carry very high price tags. Industrial land prices have been climbing, so we now have got very interesting multi-level distribution centers being built. But e-commerce is also driving demand and supply. I guess all of you sitting at home on the lockdown, on the MCO, has turned to Lazada for some comfort on retail. I've seen my wife every day. Lazada comes 5 times to the house and keeps dropping parcel after parcel after parcel. But sometimes you find it hard to find things. You can probably find it on the website, and they order, and you get it in a fairly decent amount of time. Yeah. So high quality industrial estates will transform the industrial landscape in this country. And it's very encouraging to see that people are actually now stepping up to the plate to do this. So these are 2 graphs, as you can see. This is the axis graph. If you go back to February, it's trading only 180. Now it's trading 191. So they've done well. They went up to $2 and then fell back a bit on the negative sentiment of the COVID, but it hasn't dropped. Now it's gone back up again. It's now hovering between 190 to $2 a share. Atrium dropped quite sharply down to below $1, and I think they're slowly clawing back. I saw their numbers today. I think they were close to $1 now, nearly 99 cents. So they're making a recovery. Okay, so both these stocks are considered to be fairly stable and hasn't lost investors a lot of money. The dividends are still very attractive, and they're paying dividends every quarter. So you get money a check in the bank, a check in the mail very regularly. So the office REITs, the number in the market here. You've got MRCB Quill, you've got Amfirst, you've got KLCC, Tower REIT, UOE REIT, and AHP. Okay, the trouble with office is that it's horribly overbuilt. This is actually 1918 numbers. I think the 1919 numbers are also equally frightening. So all this space is coming on the market and is creating a lot of disruption in the rental space. So much that rents are softening and tenants are being more demanding. It's a tough market to operate in now. Unless you have a very, very good product, you will not be able to worm your way out of this. So there's the kind of office space that you see in the Equatorial's new office block, leased a huge chunk of it off to Standard Chartered. Those are the kind of deals you're seeing. But it's a grade A office, platinum green building. So the ones that actually have invested in upgrading and making their offices really attractive are the ones that actually maintain their rental rates and also manage to attract and retain their tenants. But having looked at COVID and distancing and all the other stuff that's coming with it, trying to look forward to what the new offices are going to look like, I have very little idea how people are going to manage that process. Because, people will start opting to have half the staff work at home for a week, come to office for 1 week, or rotate around, and probably need less space at the end of the day, because they might find it easier to have less office space to work with and use more flexible office hours to get this thing done. They've embraced technology in a phenomenal way to make sure that the offices are working, and they are working through the shutdown, and don't think any productivity has been lost. But now people are measuring out, do they need all this office space or not? Because it's a big cost. The other big issue that's going to rise is the air conditioning systems, because the research is showing that in confined spaces with recirculated air, the COVID virus can actually suspend in the air for some time and spread through air conditioning systems. That's why I had a huge problem on the boats, the cruise ships. So many people infected. So no one knows whether all these air conditioning systems would have to be retrofitted with some form of HEPA filters and UV lights to destroy viruses when they're recirculated. So that's a big business coming up there. And I think people have to make those investments to keep their occupants happy. And centralized air conditioning systems may be a thing of the past, but I think there'll be more on separate floor-to-floor kind of systems, which can be isolated very quickly and not contaminate the entire building. Okay.
So, but how do you see? Because do they also have long leases? I mean these office buildings.
Yes, they do, Alvin. I think that you see many of the cases, like KLCC's long lease. You have Towers just announced that they're going to be buying the DC Tower in Damansara, and that comes with a long 10-year lease. Amherst actually has all their long leases are slowly coming to the end of their life, and I think they're going to have a struggle now to release out the spaces. One metric people should always look at in the annual reports, if they are published, is called the WALE, W-A-L-E, weighted average lease expiry, because you average it out for the whole portfolio and see how many years of rental you're guaranteed without having to worry about renewals. And then you check every year whether the renewals are good or bad, because the WALE, if it's rising, means they're getting better products coming in with long leases attached to it. The attractive thing about industrial is that normally the big industrial spaces, the minimum lease is 10 years, and they normally will not move. Once you have a logistics organization in your building, they're very loath to shift out and give it to their competitors. So they hang on to it. So they actually stay on for very, very long periods of time without too much bother and releasing. So I think that offices are going to be a real struggle. The good ones are still there. You have, let me see. You got KLCC, okay. Although they have the KLCC Mall in there, but they're very skewed to the Twin Towers as the icon. They've actually always been trading between $7 and $8. It's a very small band, $7.82 to $8.20. They're not losing too much money. They're stabilizing now, and the share price slowly starting to creep up again as the panic slowly eases off. Don't forget, at this point in time, for all investors, you notice that our new case infections are dropping and dropping quite dramatically. I think today it was, I think, about 19 or 20 only.
Yeah.
So I think people are feeling more confident that maybe we've turned the corner and we should get back to an open, start opening up the economy again, and people get back to work. And I think people have short memories. They may forget, but I think the habit of wearing masks is going to remain for some time.
Yeah.
The problem is I never see people smiling anymore.
Dada, what are your thoughts about are tenants? I mean, during the MCO period, is a force majeure something that is that they cannot pay rent?
Well, I think you have to look at their tenancy agreements, Alvin. Some tenancy agreements carry a force majeure clause. Okay, some don't. If they have a force majeure clause, they can actually enact it and negotiate for a rent-free period while this thing is in force. Some REITs are trying to avoid that by trying to defer the rent and asking them to, like, if they give them, like, if it's going to be 1.5 months a lockdown, they'll move that 1.5 months rent and spread over the next 12 months. But they'll just tick up the rent a little bit, so they pay it off in bits and pieces. Some have taken the bullet. So if those REITs are actually giving the free rent, they're going to have a bit of a dip in their income. If they give me a 1.5 months rental over a 12-month period, it's going to be about a good 10% reduction in their revenue. And when the revenue drops, the overheads don't drop. So, there'll be a bit of an intersection. So the dividends will actually fall this year. But don't forget, they'll be back next year. So if the share price is pummeled down because of this, because of a 1 year bad performance, because of this MCO, you can guarantee that it'll be back up next year and you make a ton of money. Okay. So pick your winners carefully, but pick the quality, the REITs that are well managed, that have good balance sheets, reasonably low debt, and reasonably long leases. Some may decide to do this and then continue on next year to pull back. You will expect some dip in earnings this year. That's a given. You can't avoid the fact that we're really facing a very, very tough economic environment. And you can't expect the REITs to perform above normal. So I think they'll actually drift down a bit this year, but it's a good time to actually pick up quality stocks if you're looking for something to invest in. They always give you a dividend. The thing I like about REITs is you always get a dividend. They'll never not pay a dividend. I don't think there's been in the history of the world a REIT that's failed to pay a dividend. So I think if you're looking for something that will give you some money, I think this is the kind of product you should really look at.
Yep.
Yeah.
Okay.
So moving on, these are the other two. Well, you got healthcare, this 𝐊𝐶𝐭𝐿. If you look at their share price, do you see any change? No?
Nope.
Pretty rock solid, okay?
Yeah.
They've been fairly consistent in their share price and they've done very well, I think, throughout this whole pandemic. Hardly a blip over the COVID period, because hospitals have never been busier. And of course, they're basically on master contracts with the 𝐃𝐵𝐽 holding company. So they have no fear of rental degradation. Their rents are fixed.
These are all 𝐃𝐵𝐽 hospitals?
Most of them, I think they have maybe bought 1 or 2 healthcare or aged sort of retirement homes in Japan. It's a long time since I checked their portfolio, but they're diversified a little bit. But by and large, the majority of their portfolio is in 𝐃𝐵𝐽 hospitals, where there's a master lease in place and they collect the rent. Okay, so there's very little dip in their income. So it'll be very solid during this rather volatile period.
What do you mean by master lease? Is there an extended period?
No, basically when I think 𝐃𝐵𝐽 injected the hospitals injected the assets into the REIT, they came back with what I call a master lease, which meant they leased the entire properties out, okay, and operated them. So they pay a rent back to the REIT, and that rent's guaranteed by 𝐃𝐵𝐽. So there's very little likelihood that they'll actually default on it.
Okay.
So I think that's very low risk kind of arrangement they have there. But again, when you look at any asset, any REIT you want to go in, please pick out the annual report and have a good thumb through. They're very transparent documents. They report everything. They're really the most informative annual reports you can read, and quite easy to read as well. Quite simple.
Okay.
So then we have the 2 other REITs, which is hospitality and diversified. Al Salam is diversified, and YTL is obviously very much in that zone. So they both had, Al Salam has also fallen off quite badly since their listing. They're down to about 70 cents. So they listed, I think, at nearly $1. So they're down quite a bit. Okay. And YT, of course, as you can see, March, bingo.
Yeah.
Free fall.
Cliff, off a cliff.
Absolutely crashed, you know, because the hotel's shut, there's no income. So they still got overheads to run. So there's going to be quite a bit of a problem. But you all forget that all these contracts are master leases, largely by YTL Group. So YTL is guaranteeing the income to the REIT. So these guys, I don't think, will lose any money. Again, go and check their annual report and see where they stand in terms of their leases and the force majeure clauses. I don't know if YTL will enact that and not pay the rent. But if it does, it's only for that 2 months. Irrespective if the hotels do badly, they still got to keep paying.
Yep.
So we come to the next stage, that is the new normal.
This is the exciting bit, right?
Well, you know that since this thing has happened, I'm not sure if any of you have realized, I can now look out my window and see 10 miles clear. I haven't had a hazy day since March 18th. The birds have returned to my garden, okay? Everything, the nature sort of healed itself miraculously. You can see pictures from all over the world, how the ozone hole is healing itself, how everything's looking so much better and fresher. People are going to say, maybe we don't have to be a consumption-based economy anymore. And people are learning to, I think, cook at home, start with, and eat much healthier foods to begin with. So unless they get McDonald's from Grab, which a lot of them do. But there's a change in how people look at home delivery of food, how restaurants are adapting to the new normal by offering online food deliveries. Even the PJ Hilton, the Japanese restaurant, sent me and says, I can deliver bento boxes to your house, you know? So they're actually trying very hard to keep their businesses running. And you'll see a brand new set of businesses actually emerging from this. So new normal means not only change in consumption patterns, a change of attitudes also. People may travel less. They may take less holidays. I think the holidays are going to be quite difficult to predict from now on, because countries have got into lockdown now, and people are very worried about traveling to other countries, not knowing how bad the virus is there, unless the thing sort of completely dampens down and goes back to some kind of normality. So that's something that we have to look in the next few. So there's always opportunities in chaos, you know? So I think there's no Chinese saying, the recession means dangerous opportunities, if I'm not mistaken, right? I think the impact on all of us, economic, financial, even our social lives, market have not only tumbled, but now into deep bear territory. Amid the chaos, there's opportunities as weak market prices are sometimes a chance of a lifetime to buy stocks. We'd never dream of owning at such bargain prices. If we looked at the bottom of the KLCI, when the 100 stock index hit 262 points in 1998, I was there. Maybank was selling at $250 a share. It dropped from $8 to $250 a share. If I bought at that point in time, boy, I'd be making a lot of money today. Okay. And then in 2008, there was another dip, but Malaysia wasn't affected that badly. 2008, 1998 was really, really bad. The market just crashed.
Yeah.
So have we seen the bottom? I really don't know whether the bottom is there or not. People keep saying that America is due for another big drop. They seem to be, I don't know what's happening in that whole stock market. They seem to be, I think, smoking marijuana or something, but they keep pushing the markets up on the worst economic news you can think of, you know, debts rising, jobs, you know, job declines, 22 million out of work. Still the stock market goes up. Oh, because why? Because I think Mr. Trump said, drink Clorox and you'll be cured. No, I think it's scores. But, you know, granted that first cure is maybe a washout. Q2 could be worse as MCO extends. It'd be sheer luck if we could reach normality by 4Q this year. So When we get through this debacle, there will emerge new normal. It won't be anything like the one after the global financial crisis. That new normal was merely an overhaul of the financial systems. This is now seemed to reverse course, and all the greedy guys are back in action in Wall Street. This time will be different. This world has been hit all at the same time, and the results can be terrifying. I've never seen a world have. Normally we have recessions. They tend to be confined. America's having a recession, or Europe's having a recession. Then Asia does well. But this time, everyone's been hit. So I'm not sure what we can expect when we go back to the new normal. Okay, just some pointers, okay? There'll be a drift from free foreign trade and globalization towards protectionism. That could happen. That will mean higher prices. Buying habits will change as more customers turn to e-commerce for their shopping needs. Malls may be affected. They also may have to reinvent themselves to a bricks and clicks motor, become omni-channel retailers and not single-channel retailers. E-learning and video conferencing become the center stage. It could revolutionize the way our education systems work. Universities are now looking at giving courses online. I took one recently that was actually given to me by, I signed up for a course from MIT on a real estate course. It lasted for 6 weeks. It wasn't that expensive. I didn't have to leave Malaysia and go sit in the US and spend a fortune. And it was very, very informative. I learned a lot. So these are becoming more popular. And if you look now, the number of webinars that are going on, which are sometimes extremely interesting and extremely beneficial, will become really something that people look at doing instead of going to visit and going to conferences.
Mm.
So if the consumer remain cautious much longer, believe me, they will remain cautious much longer after the crisis subsides. Spending patterns would. I've never saved so much money in my life this last 2 months. Hardly spent anything. Okay. I keep going and buying things at the supermarket. My wife keeps scolding. There's no more space in the fridge. But you have this need to spend money. So the only place I can spend it is in the hypermarket. So global companies have learned their lesson from centralizing supply chain from a single source like China. So there'll be more diversification of supply in future. Barring all our protectionism, global supply will continue to exceed worldwide demand as we sort of our consumption patterns still bent on destroying the planet. The plunge in crude oil prices will force the Saudis and Russians to cooperate. But this is the signal of the end of oil. Banks that don't embrace fintech will find themselves out of business. The way we spend money, the way we actually operate our bank accounts are going to dramatically change. Tourism and the airline industry will consolidate or go bust. One or the other will happen. Believe me, folks, the bear market has arrived, and this time it's a global bear market. I've never seen a global bear market in my life. But this time it's really all around the world. So let's go back and remember why we invest in REITs, okay? Firstly, it gives you access to a portfolio of quality real estates. There's predictability in income stream. It's a liquid proxy to physical property investments. Daily pricing is very transparent. High disclosure and transparency. A very low entry cost. You can buy only 100 units to get into the market, and it's managed professionally. It's very low on the risk reward curve, okay? It's just above bonds and below ETFs, okay? Now, what are the 4 key characteristics of an ideal REIT? A REIT should not be overvalued. Inspect their NAVs. That's a very important thing to look at. If the unit price is trading to a premium, then ensure that the REIT is growing its portfolio and distributions year on year. These REITs provide the investor the best total returns. Ideal REIT need a good outlook. The asset class and the sector outlook is very important. In addition, look at its debt structure. Avoid highly geared REITs. And ask what debt is long-term and what is short-term. Positive rent reversions are important. Rents must be able to increase year on year. And look for other macro trends. Now, REITs offering data center points to a huge growth market and stable outlook. Okay. Data REITs there's one data REIT in Singapore you check out. That's 𝐃𝐚𝐭𝐨 REIT. That's 𝐃𝐚𝐭𝐨 Data REIT. It's done phenomenally well since it's listed. Fantastic performance. No give up in its usage. They're very popular real estate assets.
So now that the world has shifted online, they still need a place to store their servers, right?
Absolutely. And Malaysia put the hand up and try very hard to offer that for them, because don't forget we have a lot of surplus power in the country, which can actually be supplied to the data centers, and we should team up with Singapore to actually. I think Johor will be an ideal location, so we can tap into their into their pipes that go out from the country through Singtel. I'm sure we get a lot of people wanting to move there. There's a lot of land in Johor, ideal for setting up data centers. Perfect. Okay. So if it has a growth story, there's growth in DPU, and unit prices will increase. That's how you get your story, when it starts off at a low price and grows over the years. To give you an example, when we listed Axis REIT, it was $1.25 a share. It went all the way up to nearly $4 a share. Then we split it into two, and it went back to 180, I think it was. And now it's back up to 194. So if you actually had bought at 125, you'd be laughing all the way to the bank. You would have paid back your investment and you'd be getting 15% return on your cash as of today. So check out those REITs that are aggressively developing new assets as they provide much higher yields. Don't forget that REITs can also develop now. And when REITs develop, their returns are much higher than buying it from developers, because developers actually take their profit up front. REITs actually pass that profit back to shareholders. So the yields on actually own developed assets are much higher than what you can acquire in the market. So REITs that are actually building their own assets also provide you a growth story that must be very well looked into and backed, because that gives you a very, very interesting upside when you make those kind of investments. Okay, make sure they have a good capitalization rate, not just dividend yield. Your cap rate is the rate of return against its asset value. Okay, DPU is a measure of the REIT's income against its market capitalization rate, or against its share price. So share price low, DPU up. Share price goes up, DPU comes down. That's the normal metric here. So the capitalization rate is what you should really look at. Okay, against asset value. It says always see what the performance of your asset is at 1, NAV of 1. That'll tell you how the assets are performing in the market. It's a true test of performance of the portfolio and its ability to generate high returns. So 3 things to do when buying REITs during COVID-19. Okay? 3 things. Only 3 is up here. Decide what level of risk you're both willing and able to tolerate. Avoid retail if you want to minimize the downside risk. Second, understand what types of leases are stipulated. Net leases are the safest type of contracts. Okay? Which means that it's a net income. Everything else is taken care of by the tenant. Third, determine the additional borrowing capacity of the available liquidity to close potential gaps in the cash flow. Investment grade REITs with no large near-term debt maturities are seen to be very defensive. So these 3 things you should actually look at. Okay, the leases. Okay, what risk you wanted to take, and check the gearing of the REIT and its ability to have some cash flow to back them up in this downturn. So with that, I'd like to thank you all for listening to me for the better part of an hour. Gosh, I don't know how to shut up sometimes, but I do enjoy the subject. So I'll unshare right now and go back to you want to leave this up here, or shall I take it down?
Yeah, you can. We can take it down and then.
I can put it back up if I need to. Okay.
Yeah.
Okay. We're back.
Okay. Cool. All right. So we have a ton of questions that we have gotten. Benny, I don't know. You want to start first?
Yeah, I think we start with the later one, because people is asking about since you're talking about data centers, right? Why there are 2 questions to this. Number 1, why are the property guys are not investing in data centers? Number 1. Number 2 is, can the current REITs that the fund managers that are managing the estate, the properties, are they able to shift to data centers?
Well, it depends on what asset class they really want to be in. Some people can switch gears. Sometimes I think REITs say, "Oh, I'm only doing this," and although the market's bad for this, they still say, "I must keep on doing this." There's no hard and fast rule. You can actually switch gears, And I had a policy when I was running Axis that every year I will sell 1 asset. I call it culling the herd. Your lowest performing asset, you get rid of it and invest it in something that gives you better returns. So if you do that, your portfolio is being refreshed every year. You're getting new assets on board, and you're actually making a big difference to your returns. Now, when you can switch to data centers, there's nothing stopping people from doing that. The only trouble is in Malaysia, the availability of good data centers are very, very rare. We don't have a very big data center industry here. We never promote it, primarily because the cost of internet is so expensive. because we haven't got enough pipes leaving the country. You know, we've not invested in actually connecting to the rest of the world. Singapore has. They connect to the whole world in terms of connectivity. We haven't done that here. And our cost of connections are high. That's why our internet costs are much higher than other countries. Thankfully, the last government brought those prices down quite sharply and increased the bandwidth. Otherwise, you won't be able to enjoy your Netflix nowadays in the lockdown. But I'm saying that, you know, once we can promote this, I'm trying to say the government has got to play its role in basically starting up projects to bring data centers into the country. Because I think the investors in data centers like the Microsofts or the Googles or the Amazons of this world, they're very secular. They don't care where it is. It can be anywhere. It can be Mongolia as far as they're concerned. So long as they can connect up, they can run. Because data centers don't need a large workforce. They operate with very few people and very minimal sort of structures, but they're very expensive to build. And the big question mark here is, how do we value a data center when 60% of the cost is in equipment, which is depreciating? Now, I think if you look at Keppel's experience, they've gotten around this by having what they call enterprise value. So sometimes the valuers also have got to be a little bit more active in the way they actually look at valuations. And there's been a big debate how you value data centers, but it's very central to an investment. How you invest in it, how you actually value it, that has to come under a proper guideline and proper give the investors a lot of comfort that this is the real valuation. So I think that also needs to be sorted out here, and it should be able to be done quite quickly. So I'm hoping that that will be done soon. But it doesn't stop companies from here investing in data centers overseas. Malaysian REITs are very, very shy about investing overseas. YTL has been the only one that's actually been very active in the Australian market. And they've done very well at it until now, okay? But I think that when the hotel market comes back, the Australian hotels will once again return to strong profitability again. So that's my take on data centers. If you can find one, it's worth putting some money in, because they'll always, you know, there's an expanding market. They never go out of fashion. They'll always be in demand right now because we're moving into the digital world at a very, very rapidly expanding pace.
All right, thank you. Okay, maybe another question here. This is about mall REITs, right? This is from Abdullah Izzuddin. Dividends aside, how can capital gains grow for mall REITs investors, given that mall REIT can only increase rentals, maximize car parking fees and occupancy rates before they start to reach a plateau? How can they actually, expand further?
Well, it's a question of reshaping how the mall operates. You know, if you have retailers that have a certain quality there, if you change your mall design and got better paying tenants in, it could work. Remember the old department stores that used to anchor shopping malls? They're all closing down.
Yeah.
I mean, Macy's, Sears, and overseas, all the big shopping. Look at the ones in UK. They've all closed down because they've become dinosaurs. Okay. Yeah. So what's happening there is that they've taken back those spaces and reinvented them. I think when Parkson pulled out of KLCC, I think KLCC were overjoyed. They could rent out their space at a much higher price. Don't forget, anchors pay rubbish rent, okay? Very low rents. So when they move out, the malls have a chance to reshape the spaces and do much better. I think Pavilion showed that they're very good at that. I think when one of the big retailers moved out and released about 100,000 square feet, they turned it into another destination for fashion and did very well from it. So it's how the mall operators work. They can actually add value. So I think that there's not a question of being finite. There's always inflation, but, you know, things always go up. But I think that at the end of the day, growing your REIT is more important, as well as trying to squeeze as much value out of your current assets. If you add a mall a year to your portfolio will fly because your accretive income will increase, your share price will go up, your DP will go up. But if you're sticking with the same asset year in, year out, yes, there will be a challenge when you may hit a plateau. So unless the mall is willing to grow, it will reach a point where, you know, it become returns will start to become very, very small. They can't push the envelope out anymore.
Dato', I've got a question here. You talked about the new normal and post-COVID-19. So I've got a question here from Hee Kyung Lim.
Yes.
He's saying, you know, in your opinion, you know, what kind of REITs do you think, you know, will be sort of the ones that will actually survive and thrive post COVID-19? You know, what would happen to mall REITs, or do you think industrial and commercial REITs are really where that growth is going to continue from? Basically, which segment do you think growth, apart from data centers, where do you think the growth is going to come from?
Well, I've always said this particular market at the moment, if you look at the way the world is looking at industrial REITs, okay, mainly the logistics-based REITs, they're basically the darlings of the stock market right now. In Europe, they trade at yields far lower than office REITs. They are picked up and they're kept because they're reliable sources of income. The markets are growing. They never lose tenants. And in fact, they keep adding space every year. So the people actually get on them as tenants, have an opportunity to develop new assets for their clients as they're hungry for new space. So they can grow their REIT also from a development point of view, as well as from buying new assets. So I think the industrial space is very, very interesting. The hospital space is also equally interesting. But what you also see happen in this market, I think there will be consolidation. Don't forget, there's a big bipolar effect in this market. We have the big REITs, which are doing well, and the smaller REITs, which are really struggling. Okay, so what you're going to see is consolidation. You see happening in Singapore now, where I think 3 industrial REITs have combined to form one. Fraser Centrepoint have combined their industrial and their mall REIT together into one offering, and it just made the whole market size much bigger. So you're seeing this happening around the world. So you'll find that Malaysia may have fewer REITs, but bigger REITs, and ones that actually have a stronger capital base to grow. And the management, of course, will also be looking at ways. I think we should also look at going offshore. This particular time gives us a very strong opportunity to try and look at offshore assets in a downturn. You don't get this happening very often. Don't forget, for people who are looking to buy assets, the last opportunity was in 2008. That was nearly 12 years ago. That is now returning to the market. So REITs should be on the lookout now, on the prowl, to find really good assets and start accumulating them for their portfolios. The smart ones will do that. The others will just look and hope that nothing blows up in their faces. I think you'll have to pick the winners and losers very carefully.
Okay. But do you think that, sorry, just follow up. This is actually from Sammy Cheng. But do you think the retail and literally office REITs will just be, you know, a slow, painful decline? Do you think that that's likely going to happen with the new normal?
I think you look at the REITs from 2 perspectives. You know, sometimes people just look at the regional malls as, you know, poo-poo, you know, kampong malls and things like that. But surprisingly, they're very, very popular. They get very good take-up rates and very good traffic coming through them. So, I mean, you know, we'll find probably more portfolios of non-scale based malls entering into the fray with reasonably good returns. We've seen it happen on the East Coast Mall, Capital Malls redid that whole mall and really gave them sparkling returns. The regional malls actually do much better than the ones in the city now. The city malls tend to be very dependent on tourism. And tourism, I think, is going to stay away for a while yet. I'd be surprised if it rolls back. I think people are very wary about, you know, tourists coming mainly from China, for instance. You know, they worry about the Wuhan effect. So you'll probably find that people shy away from traveling or that. So you find that the malls that are out of town, they basically have local population, local customers, and they're quite loyal and they keep them going. So you'll see that some of these malls will merge and maybe hive off some of their weaker assets and trim down their portfolios and start reinvesting in reasonably good returns for the investors.
Thanks. Benny, you had something?
Yeah, I just want to basically do a small announcement before we proceed further. Guys, we are going to go with this session until 9:30 p.m., right? So the Chinese session, the Mandarin session is only going to start at 9:30. So you can stick around and continue to ask questions to Dato' Stuart Lebroy over here. But in the meantime, I just want to make a short announcement regarding our free equities tracker platform. For those who are still new with us, you know, we are actually giving out a free access to our equities tracker platform up to the 30th of April for those who are already subscribed to us before the 16th of April. all right? But for those who subscribe after the 16th of April, even if you subscribe today, you're going to get a 2 weeks extension, right? So make sure that you're able to access it. And if you want to access, information about all the REITs that are available in Bursa Malaysia, you can also access it through our Equity Striker platform. You can look at their financial performances there itself, right? So all you need to do is to WhatsApp us at 603-8408-2070. And for those who are asking about the slides will also be available tomorrow probably, right? We're going to upload it tonight. So if you WhatsApp us at 603-8408-2070, and when you select English freebies, tomorrow you should be able to get Dato' Stewart De Bruy's slides, right? So to get a clearer picture of what he had just mentioned earlier. And you know what? This video will be recorded, so you can play along the slides with the recording, right? And if you missed earlier, because we have, I think when we started, we have about 200 plus, and now we have about 500 to 600 people, even on YouTube, plus YouTube subscribers, right? So please WhatsApp us at 603-8408-2070 to get an Equity Striker platform. And if you subscribe now, you get a free access now. It's going to be until 2 weeks. You have a 2 weeks access, all right? And for those who already subscribe with us or use the platform for more than a month, in the next 1 or 2 days, we're going to announce a special package for you guys to continue using the software. All right, so just bear with us, just hang on. We're going to announce it on our investors KopiTime, or you should be able to see the announcement on our Facebook page as well. So do like our Facebook page. All right. Thank you. So now let's just continue. Do you have any questions, Alvin?
Dato', we got one question here. Are you able to give us an idea how REITs actually leverage? Because you're saying just now that SC has set a rule of 50%. Is it just like a normal bank borrowing, or is it a bond? And when you talk about expanding their portfolio, can you give us an idea how that happens? Like, do they have to raise money from a rights issue to continuously grow? Because if most of the earnings are given out as dividends, how are they expected to grow unless they give dividends out in units instead, right?
Yeah. Okay. There's a formula to do this. It's not terribly complicated. Normally, the SC has put the limit at 50% because they don't want REITs to speculate. There was an old quotation by Sam Zell who said, "Leverage is my favorite beverage." You can have a 90% leverage REIT that gives you 20% returns, because the moment the valuation drops, you're toast. Okay, so very dangerous. That's happened in 2008. All these highly leveraged balance sheets absolutely went south, and everyone lost their money. So they lost all their equity. But I think that they put the 50% limit there just to protect the unit holders. And I think it's a very good practice. Now, for instance, debt is something that is very important to give better returns to a REIT, because equity is supposed to give out, say, 6.5%, 7% to your unit holders. But you can borrow debt at 3.5% to 4%. So that's what we call an arbitrage. Say you're giving out 6.5% and you're borrowing at 4%, there's 250 basis points that go straight to your bottom line. Because normally when you give your unit holder a dividend, it's 6%. When you pay the bank, it's 4%. Okay, so when you buy an asset, the difference goes back to your profits, and that goes back into distribution. So when you talk about how they actually leverage, normally if there's headroom, they would borrow, okay, from the banks. Now the bank borrowings can be two types: long-term, short-term. All right. Now long-term can be the form of bonds, which means you only service the interest. Okay, you can have a very big bond issue, and you can claw into it as you move forward. You can refinance your bonds by issuing new bonds and move along that way. Normally, most banks, when they lend to a REIT, it's basically an interest-only loan. There's no principal repayment, so that thing applies. So the REITs can actually get the arbitrage working very well and accrete their new products in the market called perpetuals. I won't go into that; it's a very complicated subject. But there's another way of funding debt. And perpetuals is something they say is debt disguised as equity. So I call it a time bomb if you're not careful. But having said that, say for instance you are now at 40% gearing, okay, and you want to grow. And assuming your REIT's doing very well in the market and you have very good institutional following, what we used to do at Access REIT, we would then do a placement. You're allowed to place up 20% of your units of distribution into the market privately to basically investors that are called wealthy investors who have assets worth more than $1 million, $2 million, or to institutionals. So when we would then offer this to the market, we would raise, maybe $200-300 million, okay? And this will be snapped up. We put it in the market, we close the books in 2 hours. It'll all be taken up. So we get the money in, but the important thing is when you try and bring money in, you must be able to spend it. When it sits on your balance sheet and not spent, it drags down your returns quite badly. So we only go into the market when we know we have to buy something. So we'll actually negotiate a whole portfolio, okay? We bring in this capital, reduce down our short-term debt, which is normally in the form of revolving credits, down to almost zero, borrow it up again to buy the new assets. So those go back in the frame, the yield goes, the debt then rises back to 35 to 40% again. Then we start the cycle again. So we place out, we bring down debt, we buy. Place it down, bring down debt, we buy. So with that, you grow the portfolio, and all the time you're accreting the fund, which means you're adding more value to the DPU and adding more value to your share price. And if it's actively done, it gives very good returns to shareholders.
Okay.
I
have
go
ahead.
He has already asked this question for quite some time. Dato, can you help to explain, or what's your opinion on the prospect of senior living and retirement homes development in Malaysia?
Yeah, actually, I was going to ask that as well. So just nice.
I don't think we're ready for it.
Not ready for it.
I don't think we are. There are certain pockets. It depends very much. They try and do it for Japanese clients. There are a few places in Johor that's done it quite successfully. But as an asset class, it suits more the wealthy countries with like Australia and US and things like that. I don't see many old people playing golf here.
Do you think it's cultural? Because
it's cultural.
Because we tend to our age parents tend to live with us, and it's quite taboo to actually send them to an aged care. Do you think it's cultural?
It's cultural, very much cultural. The Asian cultures are very different from the Western ones. We tend to be more family oriented. We tend to have a 3-generational home. The thought of hiving off your parents to some retirement home is unheard of. It's becoming more common, but I think that it's expensive, and the way the Australians do it means these people must be fairly well heeled to be able to afford to do that. It's more like a Club Med, really, rather than a home built for old people. But having said that, I think the areas that are interesting are the what we call the hospitals that handle older people with dementia who are basically in geriatric confinement, and their families cannot take care of them anymore. When your parents get dementia and start wandering around out of the house and disappearing, and the family sort of drop everything, rush back to the house, and the parents don't know half the time where they are. These facilities actually are maxed out at the moment, but they're not big enough to form an asset class. They'll form part of a hospital investment, a diversified hospital investment. I see them part of an adjunct onto a hospital REIT, but not quite an asset class on its own. We don't have enough stock in Malaysia to do that. You can acquire these assets overseas and bring them into your book. You can. The returns are apparently quite good. But I think that, having said that, I think the local market is not ready for developing such assets at the moment. It's a very, very niche kind of product. You won't be able to get scale to do a REIT.
Sure.
Okay, there's a question actually about how you can actually look at REITs on our Equity Striker platform. So guys, if you want to know, you can actually ask Alvin in a mentoring session how to look at the information. So make sure you join us in our Equity Striker ET online campus. It's a charity basis. You just have to donate 100 ringgit to any charity and join us for free. You just go to charity.equitystriker.com, right? And we actually pin the comment, so you can actually look at a pinned comment to have that link. All right, it's actually charity.equitystriker.com. So if you want to ask anything about our platform, whether you're looking at REITs or any stocks, please join us in our online campus. All right, so it's charity.equitystriker.com.
Yeah, right. Don't send us money also. It's just a receipt. We only want to see a receipt, okay? And please don't be cheap, okay? Don't send us a receipt that you donated last month, okay? Not valid, okay? We only started this initiative on the 6th of April. So if you're sending me something from March or February, that we're not going to accept that, okay? So it has to be because we are driving this so that you are also donating. So please be generous. Yeah. Dato', I actually have a question here. We hear this a lot, NAV and NTA, and we also hear NAV in the unit trust structure as well. I know it's different for unit trust. Is it the same when we look at REITs, NAV and NTA?
Very simple formula, Alvin.
Yep.
It's the value of your stock minus your debt. That's the net asset value. So depending on where your valuations stand, your net asset value can go up or down. If your valuation of your assets are degraded, your NAV will fall. But if they're continually rising, your NAV will rise. Okay. So the net asset value is the value of your assets after you deduct the debt. That gives you the net asset value. That's the meaning of net asset value. It's a very interesting, very important metric as well.
And this is revalued every year, you mentioned, right?
Yeah, you look at NAV versus share price. That's the two metrics you look at. If NAV is say 1.2 and your share price is 1.2, you're trading at neutral level. If your share price is 1.6 and your NAV is 1.2, you're trading at premium. If you're trading at 80 cents, you're trading at a 40% discount, 30% discount. So you should look at that metric very, very, very closely.
All right. I think we only have time for one more question. It's already about 9:30. Maybe you have any last question, or we want to give the ritual last question to Dato'.
The ritual, right? Peter's ritual question. Have you got any more on yours? Because we have a lot of questions, right?
Yeah, there are quite a number, but a lot of them are actually. I think you have to those who actually attended maybe halfway through. I think you have to really look at the whole video because Dato' actually presented quite a lot of stuff that you're asking questions for, right? So please do take a look at the videos. Again, if you need any questions, just meet us online and ask questions on the ET Online Campus. So we try to answer the questions to you guys, right? But so far, I don't find any new ones, Alvin. Do you have any?
Okay. So I think our standard last questions to all our guest speakers is, well, I guess it's a little bit different for you, but you're also managing a private REIT now, right, Dato'?
Yes, I am.
Yeah.
I'm not managing. I'm the chairman of the board. I've given up CEO's work. I just assist my CEO now to strategize and build the asset base.
So I guess if you're a REIT manager today, what would keep you awake at night regarding your business, if you're a REIT manager?
Well, I think the key issue is always your tenants. A tenant is your clients, your cash flow. You always worry about making sure that they're happy. I think tenant care is a key pillar of a strength of a good manager. So you must know your tenants and know what they want, because they're basically a source of knowledge and source of new opportunities for you. Because always keep in touch with them and meet with them regularly. Ask them about businesses. Can we find you another asset? Are you looking for expansion? You have to explore with them to find more opportunities for your own business. So I think making sure tenants are happy and very accessible. Every tenant had my mobile number. They can call me anytime if they're happy with my management. Thankfully, they never did. So the boys are doing a good job. Okay, so I was happy about that. But I think keeping your tenants happy, making sure you never go too heavy on your gearing. Make sure capital management is very, very important. We used to have, the 6 principles of tenant care, capital management, strong portfolio, good acquisitions, accretive acquisition. Make sure you buy well. Now, people always say, are you buying yield? I says, no, I'm buying real estate. There's a big difference. You can get a high yielding asset in maybe Bentong, but the tenant moves out, you never get someone back in to pay that rent again. So, you never get this sort of sweetheart deals. I'll rent you my asset and give you 10% yield. Oh, great deal. I'll buy it from you. And then you find the next day it goes bust. I mean, these things you have to be very careful. I always look at asset location. I look at secondary use of the asset. If I buy this asset, if this went bust or anything, what could I use it for? So secondary use of assets are very important. So you must actually be very careful how you look at your portfolio and make sure your assets have longevity and alternative uses. Not everything stays the same forever. You should really plan ahead and make sure your portfolio is refreshed and get rid of the rubbish. Eventually, some assets will get tired. They'll look, past their prime. unless you're prepared to put a lot of money into it and the location is still not strong, there's no use. Just sell it off and get something in a better location, maybe at a lower yield, but has much more potential to grow. So that's the smart moves you do when you do it. And finding the number of right acquisitions to do is also equally important. Buying well is a key cornerstone. But actually, as a closing remark, if I may be allowed to, for everyone who's listening in tonight,
Please.
don't forget that REITs are really one of the safer investments on the stock market today. Despite the fact of all the volatility, you are actually buying real estate, and you're buying quality real estate. Many of these REITs actually have some of the best real estate in the Malaysian market. Where on earth can you own the Twin Towers, or the Pavilion Mall, or Sunway Pyramid? You know, you just name some of the assets that are in these portfolios. They're real gems. I mean, Mega Mall and the Gardens, they're all really irreplaceable assets. When you sort of look at what you invested in irreplaceable assets, you very rarely can go wrong. So when you buy on a dip, you probably get the upside in the long term. REITs are basically a buy and hold. They're not a thing you sort of flip or do a quick trade on. They're basically there for your alternative to a fixed deposit or a long-term investment. Because normally a well-run REIT will steadily increase in value over time and give you very, very strong returns. That's it. That's from me. Okay.
Thank you so much, Dato'. Thank you for spending the hour and a half with us.
Not a problem, not a problem. I quite enjoyed it, so I hope it's been helpful. It's very difficult not being able to engage with the audience, but I think I'll be able to see them. I'm talking to myself in the screen, really. So a little bit, getting used to it. But I hope it went well, and I hope people are taking back something. I always believe when I come to give a talk, I want to make sure that I give to the audience, answer questions that they're really looking for. I'm not trying to sell anything here. I think knowledge should be shared amongst everybody. And happy investing to all of you.
Yeah, so we're gonna definitely take you up an offer. We're gonna get you to come and visit us at our new office.
When the MCO is lifted, I'd love to go meet you.
Yeah, after the MCO.
I wake quite often, so I'll be able to drop by.
Okay, fantastic.
We'll do that.
Yeah, guys, I've seen a lot of questions about the basics of REITs, like what is NAV, what is DPU, and so on and so forth. Now, if you want to have a session on the basics of REITs, please just key in REITs on your comment section so that we'll try to arrange maybe a basic session with you guys. All right, so just key in REITs there. So if you have more than 100 people, then we probably want to start doing it, a session for this. Right. So yeah, Dato', so we actually have about 200 over comments. So we actually sum it up and ask you the questions. We have about 600 people watching you, although you can't see them.
Right? 650 actually at the peak. Yeah,
650. Yeah. So yeah, thank you so much once again, Dr. Steven Robert, for joining us.
More than welcome. Thank you, and thank you for giving me a chance to sort of have a chat with your own investors. Very, very honored to be here. Thank you very much, both of you. Okay.
Guys, thank you for joining us, and we'll see you again tomorrow. All right.
Yeah, we'll see you guys again tomorrow. Benny will be back on tomorrow to talk about futures.
Okay. Yeah, about futures, yeah. The more risky one.
Like completely.
Benny, there's an old song saying the future's so bright I gotta wear shades. You can start with that music if you like.
Gotta get a shades
overnight and have a good evening. And I hope the session goes well. I think I've eaten some time into that, so let you guys get back to your second session, okay? Thank you.
Thank you so much, Adol. Thank you. Thanks for having us. Thank you.
Yeah, good night, everyone.
Good night, everyone.